The US dollar did not achieve global dominance until after World War II, though its rise began earlier during the late 19th and early 20th centuries. As the US grew in prominence, the State Department during the 1910s launched a foreign policy called dollar diplomacy. This policy aimed to advance the interests of US private firms abroad, particularly in Latin America and Asia. American companies were encouraged to engage in foreign trade and invest overseas. Dollar diplomacy involved not only the promotion of US trade and investment, but also the expansion of the dollar's use in global markets, a practice termed dollarization diplomacy. However, apart from Puerto Rico, US policymakers did not actively push for the dollar to fully replace other nations' currencies. The objective was to promote the use of the dollar alongside local currencies rather than making it the sole legal tender. If we look at the past 50 years, the move towards dollarization in Latin America has been driven by economic crises, hyperinflation, and the desire for greater stability. While full dollarization is rare, the influence of the US dollar remains strong throughout the region, particularly in times of financial distress. According to the site Investopedia.com, dollarization is a form of currency substitution. Governments may choose to partially or fully adopt a foreign currency, typically the US dollar, in addition to or instead of their own. This usually occurs in developing countries with a weak central monetary authority or an unstable economy. Dollarization can occur either as an official monetary policy or as a market-driven process. In this case, the US dollar becomes widely accepted for daily transactions within an economy. Sometimes, it even assumes the status of legal tender in the country. Governments adopt dollarization to take advantage of the dollar's stability, particularly in situations where domestic inflation erodes the purchasing power of their own currency. However, one consequence of dollarization is that the country loses some control over its own economy, as it can no longer adjust its money supply through independent monetary policy. Dollarization in El Salvador is a notable example of official dollarization, where the country adopted the US dollar as its legal tender. This process was intended to stabilize the economy, promote growth, and foster foreign investment. Before adopting the US dollar, El Salvador used the Salvadoran colón as its official currency. However, the colón had been losing value, and inflation was rising in the late 1990s. El Salvador's economy, while relatively stable compared to other countries in Central America, faced slow growth, financial volatility, and increasing interest rates. The government feared that inflation and further instability could threaten its economic progress. In November 2000, the Monetary Integration Law was passed, which came into effect on January 1, 2001. This law made the US dollar an official currency in El Salvador alongside the Salvadoran colón. By adopting the US dollar, El Salvador removed the risk of devaluation associated with the colón, making it easier for businesses and foreign investors to operate. The move helped reduce interest rates and bring inflation under control. The colón remained legal tender after dollarization, but in practice, it quickly became obsolete. Within a few years, the US dollar fully replaced the colón in circulation, and today, most Salvadorans transact exclusively in dollars. The colón is no longer used for practical purposes, though it has not been officially abolished. Another factor to consider are remittances. A significant portion of El Salvador's economy is fueled by remittances sent from Salvadorans living abroad, especially in the US. These have been bolstered by dollarization since families receive money directly in US dollars, avoiding any currency conversion losses. Critics argue that by dollarizing, El Salvador gave up control over its monetary policy, leaving it vulnerable to external shocks without the ability to print money or adjust interest rates. This lack of control became particularly concerning during global economic crises. While dollarization stabilized inflation, El Salvador's economy has seen slow growth since the 2001 dollarization, growing at an average annual rate of around 2%. Critics point out that the hoped-for boom in foreign investment has not materialized as strongly as anticipated. While some have blamed dollarization for the slow growth, another dollarized country enjoyed the highest growth rates of the past 2 decades. We're talking about Panama. The average GDP growth rate for El Salvador between 2000 and 2020 was approximately 2.3% per year. During the same period, Panama experienced strong economic growth, with an average annual GDP growth rate of approximately 5.9%. Unlike many other countries that adopted the US dollar in response to economic crises, Panama has been using the dollar as its official currency for more than a century, making its experience with dollarization unique. Panama declared its independence from Colombia in 1903, largely with U.S. support, which was driven by American interests in constructing the Panama Canal. As part of its early agreements with the United States, the nation adopted the U.S. dollar as its currency alongside its local currency, the Panamanian Balboa. In 1904, Panama officially adopted the U.S. dollar. The Panamanian Balboa was created as a symbolic local currency, but it was pegged 1-to-1 to the U.S. dollar, and in practice, Panama has never printed paper Balboas, only coins. The U.S. dollar has been the only paper currency in circulation since this time. By using the dollar, the country avoided the need to establish its own central bank and currency management system, instead relying on the stability and global acceptance of the U.S. dollar. Using the U.S. dollar has provided this nation with a stable and internationally recognized currency, which has contributed to low inflation and facilitated trade and investment, making it an attractive destination for international business and finance. This, combined with its location and strategic position, particularly due to the Panama Canal, has made it a global financial center. The country is known for its offshore financial services, where many international businesses and individuals establish bank accounts or businesses. There are those who claim that dollarization has made Panama a tax haven and that it has only benefited rich foreigners. While its dollarized system shields it from currency crises, it also means the country is vulnerable to external economic shocks, particularly those related to U.S. policy or global financial conditions. If the U.S. dollar appreciates, for example, Panama's exports may become less competitive on the global market, but the country has no ability to devalue its currency to counter this effect. Despite the limitations of not having a national currency, Panama has experienced robust economic growth in recent decades. Moving south, we have the case of Ecuador. Unlike Panama, dollarization was implemented in response to a severe economic crisis and has had lasting effects on the country's economy. Throughout the 1990s, Ecuador faced severe economic challenges, including hyperinflation, a banking crisis, and political instability. By the end of the decade, the situation worsened due to the collapse of oil prices, the country's main export. The sucre, which had been devalued repeatedly, became highly unstable, and the public lost faith in the national currency. On January 9, 2000, Ecuadorian President Jamil Mahuad announced that the country would adopt the U.S. dollar as its official currency in an attempt to stabilize the economy and restore public confidence. The process of dollarization was formally completed later that year, with the U.S. dollar replacing the sucre in circulation by September 2000. After dollarization, the inflation rate fell dramatically, dropping from over 90% in 2000 to around 4 to 5% within a few years. This nation experienced a quick rebound, with economic growth returning in the early 2000s. Growth rates averaged around 5 to 6% from 2003 to 2006, driven in part by higher oil prices and greater macroeconomic stability. While growth stabilized post-dollarization, the economy has been subject to fluctuations, particularly due to its dependence on oil exports and external factors, such as global commodity prices. One important characteristic of dollarized countries is that they have given up their ability to increase the money supply. This also means that their governments must keep balanced budgets, otherwise debt levels rise quickly. Ecuador has struggled with budget deficits, especially when oil revenues decline. The government has often turned to external borrowing to fund deficits. Despite challenges, dollarization is widely supported by the public due to the price stability and low inflation it has brought. There has been little political or public appetite to reverse the decision, as many fear returning to the economic instability of the pre-dollarization period. The same is true in El Salvador and Panama, where there is no public pressure or significant movement to revert to a fully national currency. So far, we've seen cases of official dollarization. However, in Latin America, there have been multiple instances where countries have had periods of de facto dollarization, where despite not being recognized by the state as a legal tender, in practice, the dollar becomes widely used for all kinds of daily transactions. One interesting case is Argentina. Here, the country's relationship with the US dollars has evolved in a unique way. There's a great book which speaks about the role of the US dollar in Argentinian society, its culture, and its politics. The name of the book in English is pretty bland, but its name in Spanish is quite revealing. It's called El Dólar, Historia de una Moneda Argentina, which translates as The Dollar, History of an Argentine Currency. The following quote from this book somehow speaks about the way the country has historically interacted with the dollar. Quote, "The use of this legal tender as a unit of reference or payment method increasingly spread to more markets and transactions, from the tourism market in the 1950s to the real estate market, art world, and automobile industry in the 1980s. In fact, during times of crisis like the hyperinflation of 1989, Argentinians used the dollar as a payment method for everyday services like plumbing or psychology sessions, though these practices later faded. Originally the exclusive focus of foreign trade actors, the US dollar has become a central political indicator in all electoral campaigns since the return to democracy in 1983. The fourth stage of the dollar's popularization begins in 1991 with the Currency Board, in which the US dollar becomes legal tender alongside the Argentine peso. In this period, the day-to-day financial repertoires of Argentine companies and families, even low-income households, incorporate the greenback. At the same time, the prominence of the dollar in the public's attention wanes as its use as a medium of exchange increases. The dollar ceases to be a topic of concern. This new balance, however, comes to an abrupt end with the end of the Currency Board and the 2001 to 2002 crisis." Unquote. The abrupt end that the authors refer to has to do with the period known as convertibilidad, or convertibility. From 1991 to December 2001, the value of the peso was pegged 1-to-1 to the value of the dollar. In all reality, the country had been keeping a facade of prosperity through massive accumulation of debt. In December of 2001, the colossal national debt forced the Argentine government to take drastic measures. Eventually, the government defaulted, which caused interest rates on foreign loans to increase. Citizens saw this spike in interest rates and decided it was time to withdraw their savings. A bank run had just started. To stop the bank run, the government implemented a law nicknamed the Corralito. This policy restricted Argentinians to withdrawing a maximum of $250 per week, later increased to $300, just enough to cover basic necessities like rent and food. Meanwhile, the government converted all US dollars in Argentine bank accounts into pesos, the national currency. Essentially, every dollar held by citizens was replaced with an Argentine peso. If you had deposited $1,000, it suddenly became 1,000 pesos. As inflation surged, the pesos citizens received were worth less than the dollars they had. Inflation had been kept low due to the convertibility plan, which pegged the peso to the US dollar at a 1-to-1 rate. However, this policy was abandoned with the Corralito, leading to a re-evaluation of the peso's value. 2 months after the forced currency conversion, the Argentine peso lost 75% of its value, with $1 now worth 4 pesos. As a result, every person with pesos in the bank or at home lost 75% of their wealth overnight. The 2001 to 2002 crisis left deep scars on a generation of Argentinians. Even today, there remains widespread mistrust of political and business elites. One of the lasting lessons for many Argentinians has been a distrust of both the peso and the banking system. As of 2024, Argentinians hold $277 billion outside the formal banking system, popularly referred to as dollars under the mattress. This behavior isn't limited to the wealthy. Argentinians of all social classes engage in this practice. The US dollar is also commonly used for contracts and large transactions throughout the country. This all means that in practice, Argentina is already partially dollarized. President Javier Milei aims to take this further by officially adopting the US dollar as legal tender. However, he has emphasized that he will not enforce the abolition of the peso. Instead, his plan envisions a monetary system where economic agents can freely choose the currency they prefer for their transactions, whether that be the dollar, euro, Bitcoin, or peso. In other countries where the dollar has circulated alongside a weaker local currency, economic agents have typically shifted toward conducting more transactions in dollars while decreasing their use of the local currency. As the volume of transactions in pesos diminishes, the need for a central bank eventually fades. One of the aspects of Milei's plan is his proposal to eliminate the central bank. He views the Argentine Central Bank as the primary cause of Argentina's inflation and monetary instability, describing it as a source of corruption and bad economic management. Other countries that have had periods of de facto dollarization in Latin America are Bolivia and Peru. Bolivia experienced severe hyperinflation, prompting unofficial dollarization as citizens turned to the US dollar to preserve their savings. However, the country retained its national currency, the Boliviano, but the dollar played a significant role in the economy. Peru experienced unofficial dollarization, especially after a period of hyperinflation in the late 1980s. By 1993, under President Alberto Fujimori, Peru introduced a new currency, the Nuevo Sol, but the US dollar continued to be used widely, especially for savings and financial transactions. But now I want to know what you think. Is dollarization really beneficial to the countries mentioned? What other instances of dollarization do you know about? This is Latinometry. Subscribe to the channel so that you don't miss more interesting videos about Latin America and the world. Please like and share this video, and thanks for watching.